5 p.m. Okay, so you're recording.
Yeah, I'm recording.
So, welcome to this concurrent session devoted to innovation. We have four papers in this session, and we will start first with Emre Gencer from the MIT, then with Maximilian Banning. Maximilian, I saw you. Yes, okay. From the Institute of Economic Structures Research. We will proceed with Gregor Semieniuk from the University of Massachusetts Amherst, and we will end with Karen Turner from the Center for Energy Policy at the University of Strathclyde. So please, Emre, the floor is yours.
Thank you very much.
First, try to share your slides. Okay, that's fine.
So is it full screen and you can see it,
yes,
right?
Yes.
Great. Thank you very much for the introduction, and I'm glad to be here. Good afternoon for the European participants, and good morning for the American participants. So today I will be talking about a framework that we have been developing at MIT Energy Initiative. And this is a life cycle assessment framework to understand the evolving energy system and also helping making better energy choices for different nations. And one of the challenges that we see today is like ultimately our aim is really to decarbonize the energy system. But there are many different ways to do that and to achieve exactly the same outcome. However, when we are comparing different options, one critical element is really how we account for the total emissions. And this is exactly why we are trying to build life cycle assessment into the energy system design and energy systems planning. Because this slide is showing emission sources from transportation options, and gray arrows are the CO2 sources. And when we compare internal combustion engine vehicles with EVs, if EVs are electric vehicles, if we are only looking at the tailpipe emissions, actually we completely ignore what has been emitted till the use of these, driving of these vehicles. So how we produce electricity, whether when during this process we are using carbon capture, so on and so forth, all matters in terms of the comparison, direct comparison of different options. And this is transportation is just an example. So we can explore and have the same examples for hydrogen production, residential heating, industrial heating, so on and so forth. So to do so, we have been developing and working on this platform called Sesame. And Sesame is short for Sustainable Energy Systems Analysis Modeling Environment. And so what we are building is really an open access platform for people to compare different options at pathway level, which is similar to this graph. So pathway is basically going through one particular pathway to understand the emission impact of that particular pathway, and systems level. And systems is the combination of pathways that can represent a city, a country, or a continent, a region, so on and so forth. And with this platform, our aim is really to be able to assess and compare different technology options, understand the benefits and potential challenges of different scenarios, understand and explore the implications of market and policy dynamics, perform cross-sector comparisons, and understand and assess the impacts of standard versus best practices. And the underlying engine is really a representation of the energy system in a modular fashion. And here, as you can see, we have used 6 life cycle stages: upstream, midstream, process, CCUS, gate user, and end use. And under each one of these, we have modules which are pretty much representing different options. And as you can see here in the upstream, we are looking at the resources, renewable energy, fossil resources. And for each one of these options, we have also alternatives. So you can have different kinds of biomass, various solar generation technologies, so on and so forth. And similarly for fossils, there is a variety of natural gas. So it can be conventional shale gas, depending on where you are, its composition can be different, so on and so forth. And similarly for midstream, we have major transport methods of all the resources to the processing state based on the phase of these transportations. And process is one of the key elements here, which is looking at how we convert these resources to the products that we are interested in. It can be electricity or a chemical or a fuel. Carbon capture is one of the key areas for really decarbonizing the energy system. And without carbon capture, it will be really hard to achieve the climate targets. So that's why we have a full representation of that value chain. And finally, on the end use, we are looking at electricity products like liquid fuels, as well as other chemicals and major products like cement and iron and steel. So with this platform, we can explore many different system choices as well as pathway choices. And I will start giving an example from power sector. And I will use California as our example, because California has seen a huge increase in solar generation over the last 10 years. It was less than 1% in 2013, and this graph shows up to 2018. In 2018, we were close to 20% of generation coming from the solar system. And the main reason we are exploring this is, of course, increasing solar is extremely valuable and it helps decarbonization, but we also should understand the impact of that kind of renewable penetration in the rest of the system. And for this California system, you can see light orange is solar, dark orange is wind, the thermal, the light gray is basically natural gas power plants, and the rest is like imports from neighboring regions, hydro and nuclear. And here you see that actually thermal is really shrinking, and which is the main differentiation between 2013 and 18, and the rest of the system is quite stable. So what we see is really shrinking in the natural gas generation. The second part of this is when we look at the generation by hour of the day, because depending on the season, as well as hour of the day, when we see some of these changes, the shape of the natural gas generation is quite different. So you can see in 2013, when we don't have that much solar, natural gas generation is quite stable. So it's for like any hour of the day, as well as across seasons, we are seeing a similar level of generation. However, when we look at the 2017, as you can see, there are many bumps and differentiation in the generation. So meaning you need to turn down the generation from power plants, natural gas power plants, or all of a sudden, like for summer months, increase it quite substantially, almost double the generation from these resources. And here the hypothesis is that this can have huge environmental disadvantages, because running steady state these at nameplate capacity is quite like optimized. However, when we introduce dynamic operation, it can have some negative impacts. This was the hypothesis, and we use Sesame platform to analyze these. And for this particular example, what we have done is we have synthesized publicly available data sources for every generator in the US and get their hourly load generation profiles. And here, then we have categorized all of these generation under 4 categories: startup and shutdown, part loading, which is close to 40% load, nearly full load, like it's up to 80% relative to nameplate capacity, and full load is basically running at nameplate capacity. And with these graphs, we have on one side combined cycle units, which are the more efficient and usually used for base load power generation. And on the right-hand side, gas turbine units. And what we observe here is that there is a huge change in operation characteristics of combined cycle units. So you can see they are start up and shut down much more frequently. So this is the difference between blue curve and the pink curve, pink bar charts, and which also has a emission implication. So what does this mean is when you look at the right-hand side, now in 2017, we are emitting more from combined cycle units from the startup and shutdown. And similarly, when we look at the emissions from other operations, what we observe that actually we start to have part load emissions increasing, and nameplate full load operations, which is the dominant like operation under nameplate capacity, is pretty much the same. So actually the differentiation is really in the part load. So we are operating these at more part load and startup and shutdown, which is impacting the overall emissions. When we look at the gas turbines, we see a huge increase in the generation from these units, and you can see from these curves. And just to give you an aggregate number, so the capacity factor for these units were approximately 5%, and now it is close to 10%. And these are less efficient relative to combined cycle units, and now we are seeing a huge increase in the utilization, which is significantly increasing the emissions from these resources. Of course, there are other implications of these kind of dynamics from the system's perspective, and one is carbon capture. So oftentimes, when we talk about fossil generation, it's easy to claim that we can easily deploy carbon capture. However, it might not be that easy. And the reason is we are observing a dynamic operation of these units. And you can see here, this is a plant from California, and we see hourly generation over the entire year. And you can see that it is always going up and down from 40% to 100%, and oftentimes it goes to zero and stays in no generation and sudden startups, so on and so forth. This kind of generation profile is pretty impractical to be able to use and operate with carbon capture. And the reason is current carbon capture technologies are similar to chemical plants, which needs to run at steady state. And once they are at steady state, they want to stay that way because you have a huge startup time, you need to heat up the equipment, so on and so forth. And when you have these kind of dynamic operation, it will be impossible or very hard to deploy carbon capture. However, there are new research going on, of course, to have flexible carbon capture technologies, so on and so forth, but it's still underway. So there is not a commercially available technology that can handle these kind of operations. And the second interesting piece about fossil plants is, as you know, there are a lot of fossil generation systems around the globe. And when we look at only the US steam turbine capacity, you can see it is currently more than 500 gigawatts. And even in 2050, we will have more than 100 gigawatts useful life from these units. Even if we want to switch to renewables today, there will be a huge implication for these assets. These will be completely stranded and there will be economical issues of shutting down this prematurely. What we propose is really, can we repurpose these plants? And one of the studies that we were currently conducting is looking at the thermal generation units converted to have thermal energy storage. So instead of burning fossil resources, can we use electricity to and use electricity to heat up a thermal medium, thermal fluid, and then use that thermal fluid when we don't have renewable electricity. And so this will be part of a new study that will be coming out soon from MIT Energy Initiative called Future of Energy Storage Study. And globally, there is a huge potential for these kind of conversions. And the economics, of course, will dictate whether these will be feasible or not. But here in this chart, you can see that actually for long duration storage, thermal energy storage has advantages over other storage options. So here we looked at pumped heat, molten salt, lithium ion, and as you can see, the molten salt thermal energy storage for especially long duration, like above 4 hours duration energy storage, can be competitive with the cheapest lithium-ion battery options, which is a promising result. So coming back to the transportation sector, so what we've also looked into is the life cycle emissions of different powertrains, and understand the impact of using various fuels and electricity for to compare different light-duty vehicle options. And here we looked at internal combustion engine vehicles in black, hybrids in red, battery electric vehicles in green, and the rest, all the blues, are different colors of hydrogen, using fuel cell electric vehicle with electrolysis, using grid electricity, steam methane reforming, natural gas to hydrogen, steam methane reforming with carbon capture, and using renewable electricity from wind with electrolysis. And the bottom line here, as you can see, there is the ranking of hydrogen is completely dependent on how we produce hydrogen. And this brings up our life cycle approach again, because unless we do a life cycle assessment, it's really hard to mislead the discussion and say that hydrogen is very clean or electricity, EVs are very clean, so on and so forth. And all of these has been published in our Insights into Future Mobility report, and you can access through the link or from our webpage. And when we discuss the electric vehicle, also there is a huge impact of how we charge and when we charge these vehicles. And so this example is looking at two very similar systems in terms of carbon intensity, New York and California. And even for these systems, they have exactly the same carbon intensity for power. Due to their shape of the generation, and in California it is predominantly solar midday, as you can see, and for New York it is the base load is supplied by nuclear and the balancing system is natural gas. And the change in life cycle and operating emissions shown in the bottom row is actually for California system, midday charging is very advantageous because you are basically charging your vehicles from solar. And for New York, overnight charging is more advantageous because you have less load in the system and your base load nuclear actually starts charging your vehicles. So the complexity is like quite significant, because also switching to EV will not be enough. We also need to understand the charging profiles, when we charge, how this impacts the grid. So it is a very, very connected system, which requires doing these kind of dynamic analysis to really decarbonize the system and minimize the emissions from any of these systems. And so, of course, the system is not constant, right? So it is growing every day. And this looks into a Southeast system where we start from today's generation mix, which is predominantly natural gas. And over the years, we expect to see a change in solar generation, which will increase the renewable share and decrease the life cycle GHG emissions. But when we look at the results in terms of the charging time of these, is actually, you can see today, the time of charging is really not that important in Southeast. However, as we move forward, as we see more renewables coming up, if we stay on the same charging profiles and if we use evening and overnight charging, we will be within 10–20% of the emission reduction level. However, if we switch to midday charging and we use the benefit of having solar generation in the system, we can significantly reduce the emissions from electric vehicle fleet. And so I think I am right on time. So with that, I would like to conclude with a couple of points. So this sustainable Sesame platform is really designed to be able to use these kind of challenging energy transition questions in very detailed manner. And identification of pathways to mitigate climate change is really important, and it's a very region-dependent problem. So unfortunately, there is not a silver bullet that will work for everywhere. We really need to do technology and system scenario analysis and do it continuously, because system is changing very fast, and we are seeing a huge demand and generation change every day. And to understand the evolving energy system, we need to use new analytical methods to explore the emission reduction options as well as the new business opportunities, because without business opportunities, unfortunately, we won't see much uptake in these technologies. With that, I would like to thank you for your attention, and happy to have, if you have any questions.
Okay, thank you. Are there some questions? You can use the button for reactions and raise the hand virtually if you have some. Yes, Gregor, you have a question?
Yeah, I can go first. Thanks very much. That is so interesting and daunting. I just wanted to ask whether you also take into account the embodied carbon emissions in capital goods that are being used in all of these stages. For instance, the emissions for steel needed for transmission lines or for power plants. Thank you.
Yeah, this is a great question, Gregor. Thank you. So for vehicle technologies, we are performing a full life cycle emissions, which includes the vehicle manufacturing as well. But your question is a little bit more loaded. So right now, we are not looking at the embodied carbon of everything. So for example, when there is a need for power system expansion, we don't look into the embodied carbon of new wires, new generation, like, for example, for hydrogen infrastructure, new pipelines, so on and so forth. However, as I mentioned in the beginning of the talk, this is a very flexible and modular platform. And we see that there is a huge interest in the embodied carbon, and we are planning to expand to include all of these infrastructure as well as other embodied carbon for the other products. But for vehicles, what you've seen includes vehicle manufacturing, and it also takes into account the manufacturing being more environmentally friendly.
Okay, is there another question? I have one. I would like to know, in your model, you use fixed generation capacities, and or do you consider some incentives for new investments?
So we don't assume it's fixed. We assume that it will change and it will require new investments. And the way we currently do it is we are closely working with colleagues from MIT who are using integrated assessment models to understand how the system will change, as well as we are collaborating with power system models to also quantify the need of new investments. But in our studies, we don't assume fixed power grids or anything. So it's evolving, and we are trying to do it like.
But are they evolving? Are they evolving endogenously or exogenously?
Exogenously, right now.
Exogenously.
Yeah.
Okay.
So it's an input to the model.
Okay. Thank you. Other questions?
I could ask one more if nobody else wants to.
Yes, of course. We still have some minutes.
Thank you. Is there something like a really surprising result coming out of the examples that you looked at? For instance, something like, oh, actually it's less environmentally friendly or climate change mitigating to do XYZ thing that everybody thinks is a good thing to do. Is there such a headline result somewhere?
There are a couple of headline results. One example I can give is from using like light duty vehicles, passenger vehicles. So actually in most of the regions, not most, but almost half of the regions in the US, using plug-in hybrids or hybrids is more environmentally friendly than switching to EVs because the power grid is not clean enough. And that was a very interesting result to see. Also, this significantly minimizes the need for infrastructure for charging and the amount of battery that's required in these EVs versus plug-in hybrids. So I think that was a very interesting result. And currently we are also looking at a very similar approaches, and we are trying to share these results with policymakers as well, just to see the value of actually we have some solutions that can be applied today that will significantly reduce the carbon intensity. Because as you know, so switching to EVs is quite challenging because of the range anxiety, charging profiles, so on and so forth. And actually, after this result, I bought a plug-in hybrid electric vehicle, honestly. So I did my part, but like hopefully there will be more incentives towards hybrids and plug-in hybrids, especially for the next 5 years, which can make a huge impact.
Okay, thank you. I think it's time to switch to the second presentation by Maximilian Banning. Please, Maximilian, can you share your slides first? Okay, it's full screen, so the floor is yours.
All right, thank you very much. I hope you can hear me.
Yes.
And welcome everyone to this presentation on energy technology goods, how they are traded, and the role of Germany in particular. Just a brief disclaimer up front, all the results I'm talking about now were conducted during a project for the German Ministry of Economic Affairs, which was carried out not only by my colleagues from GWS, but also by our esteemed colleagues from or with association to DIW. What are we now actually talking about? When following the public debate, you often get the impression that energy transition is very often discussed focusing on costs or the burden that it brings to either the economy as a whole or individual economic suspects. What you find far less, although that you could debate is actually changing in more recent times, is that these costs are actually linked to investments, and those investments go somewhere. There are goods that are necessary or required for this transition, and these goods need to be produced. And this in turn yields at least potential opportunities for the manufacturing countries that are able to not only supply but also trade these goods. And thus what we are looking at here right now is how these goods are in fact traded at the global stage. What are the main players? What are in fact the goods we are actually talking about? And as I already mentioned, we are interested in Germany's role in particular. All of this would be quite more easy if there was official statistics that would basically make a clear-cut distinction. What is this energy technology good we are interested in right now, or what isn't? But in fact, these energy technology goods are not as distinct in official statistics, but rather are spread across different industries or different goods positions. So what we are in fact doing is building on existing research, and there are existing lists that identify at least similar goods we are interested in. There are quite a few lists by now. You might be familiar with the OECD combined list of environmental goods. We used that and combined it with another list by a German research institute. And after filtering those, we identified more than 200 goods that are of interest to us at the 6-digit classification level. Then for further analysis, we aggregated those again to make them somehow more easy to handle and actually display something. All the data I'm presenting right now can be received by Comtrade. However, now that we are able to identify those goods, the problem in itself isn't really solved, because there's one large issue I think it has to be stressed. And that is that while we now can say, yes, there is this 6-digit position that includes energy technology goods, we cannot say that it fully includes those, so that every good in the 6-digit position is in fact an ETG, which has mainly two reasons. On the one hand, those positions do not include homogeneous goods, so it might be the case that some of those are ETG and some of those are in fact not. But even if it were the case that all goods were homogeneous, we are running then into the problem that, well, one good can be used for multiple purposes. And while, for example, a renewable energy system might require some sort of basic metal construction or something like that, that same metal construction might be in fact used for completely different purposes, and then not really meeting our criteria. So what that then of course means is, no matter how carefully we identify those 200 goods, in the end we are always facing the issue or running the risk that we are overestimating the amount of ETGs that we are now actually identifying. Having said that, let's look in fact at the data and maybe focus on the lower half of the slide first, where you can actually see those 5 aggregated groups we are now talking about. And I think it already becomes clear that this multiple use problem, which is why I think you should always keep this word potential in mind when I'm now talking about ETG, that this multiple use problem applies to these groups quite differently. So for measurement and control systems, for example, those are quite prone to the problem, as are goods in the group that is here called efficient use of energy, which is mainly building materials or insulating materials. While on the other hand, goods for the usage of renewable energy are far more clear-cut, distinct from everything else. What you can also see by the examples given here is that we are not necessarily talking about green products or goods, as those in the group energy transition refer to more traditional means of energy transformation. You could argue how green those are in fact. Then if we turn to the top half of the slide, you can see that the increase in trade in ETG, especially at the beginning of the century, was quite high, and the growth rates in fact exceeded those of total trade by a fair amount. However, after the financial crisis and the drop in trade, growth rates were much lower and have only picked up recently. The threshold of $1 trillion was first breached in 2017. And to put this a little bit into perspective, when we are looking at the 2018 value, again, those approximately $1 trillion account for 5% of total trade, which is quite a significant amount. You can also have a first glance at the distribution, where you can see that the goods for the usage of renewable energy account for the highest share, then follow to roughly equal terms by measurement and control systems and efficient use of energy, while those more conventional energy transformation technologies tend to be far less important. As a next step, we can already try to identify the big players on the global stage. On the right axis, you see once again the amount of total trade given by the line, while on the left axis you can see the individual shares of the big countries, the top 9 in the most recent year over time, who in aggregate account for more or less 2/3 over the complete observation period. We can see that there are mainly 3 groups of countries. There are the 3 big East Asian economies at the Pacific with China, Japan, and South Korea. We then have 2 big economies from Northern America with Mexico and the US. And then we have 4 large European countries. If you're looking at the development over time, it immediately picks the eye that the share of China is drastically increasing, while at the same time, a little bit less obvious, the shares of the US and Japan are decreasing. For Germany, we find that the share is in fact more or less constant, with Germany being the 2nd highest supplier for ETG, both at the beginning and at the end of the period, and in fact for many years in between as well. Turning to Germany, I'll only have a quick glance at this diagram where you can get a quick impression of the German ETG portfolio. The main thing to take away from here is that there's no real concentration or focus, but for groups as well as for individual positions, the portfolio is quite diverse, and especially if you compare it, as you can see on the right-hand side, to Germany's other big competitors on the world stage, you can see that the portfolio is split much more even, and only the US reaches values that are quite comparable. Now we can, of course, look at where those goods are actually going. So the diagram you can see here is basically split into halves. On the left half, you can see once again the distribution of German export by good categories, while on the right side, you can see the destination where they are going, and both halves are then, of course, linked by those chords representing the individual flows. What you can easily see on the right side is that Europe is, perhaps unsurprisingly, the main destination of German exports of ETG. But this is not only true for ETG as a whole, but if you're looking at the individual categories, you can see that the largest chord is always linked to Europe. To a lesser degree, this is also true for East Asia, where usually the 2nd largest stream goes. Here, the notable exception is North America for measurement and control systems. We can, of course, go into even more detail, not looking at the regional, but at the country level. As you can see, the left half is, of course, the same distribution as before, while on the right-hand side, we can now see the individual countries and their import volume from Germany sorted descending. So while Europe is, in fact, as an aggregate, the biggest receiver of German goods, we can see that China, as well as the US, as individual countries, exceed those. And we can see that looking at the individual chords, that, for example, China is, of course, again, the main recipient of goods for the usage of renewable energy. But for example, for the US, we can see that here again, measurement and control systems are of particular importance. And we can see, of course, the individual distribution of the European countries. As for goods, we also find a particular low concentration on the target countries of Germany, again on the right side, compared to its main competitors. And we can also see that this share that is here called rest of world is particularly high in Germany. So those top 9 countries depicted here are accounting for a relatively small share compared to other countries. I now want to turn to 2 of those target markets in particular. Maybe just as a bridge, we can identify them here. One is China, the worldwide main recipient of German energy technology goods. And you can see from this diagram that China is not only an important market for Germany, indicated by the size of the circle, but is beside that not only a growing market, but also a market where Germany was able to gain market shares, at least if you are looking at the import volumes of the different countries in more recent times. The second country I want to turn to is France, which is the largest European recipient of German energy technology goods, and is unfortunately a little bit less easily identifiable. It's in this blue cloud of European countries, but more on that in a second. Since we are already familiar with these chord diagrams by now, I once again turn to them, and we can see that the position of Germany in France is a particularly good one, so to speak. So the German market share, again, market always only referring to the foreign market. Unfortunately, we do not have any information how this compares to the domestic market. But the position of Germany among its competitors is quite good. You can see that France is mainly importing those goods from, and that mostly neighboring European countries, the only exceptions being once more China and the US. We find for Germany that it is not, again, not only the main exporter to France for ETG as a whole, but in fact also for all other sub-technology groups, so to speak, except for this minor group of energy transformation, where in fact the US is the main supplier, although as you can see the overall share of the US is quite low compared to other countries, especially from Europe. The second example I want to turn to is in the Chinese market. Again, on the left-hand side, you can see which groups of goods are actually exported from Germany, while on the right-hand side, we see the providing countries or regions. So as Comtrade provides individual data for Hong Kong, we also looked at that. And similarly to France, you can see that China as well is importing from mostly countries that are in geographical proximity. So we have not only Japan and, as I just mentioned, Hong Kong as a neighboring, or in fact, closely linked region, but also down the line, you can see Thailand, Singapore, Malaysia, and then the only European country besides Germany that makes it into the top providers here is France. Although, as you can already see on the right-hand side, the France share is getting pretty small, from which we can easily conclude that the Chinese imports are much more focused on some specific countries. As I said, mainly regions that are in close geographical proximity. And here, Germany, in fact, manages to establish itself as a main supplier of ETG. if we are looking at the individual goods, we can actually see that for measurement and control systems, Germany is the main origin. Interestingly, being the main origin for measurement and control systems, it is in turn the case that goods for the usage of renewable energy are, from a German perspective, the most important group that gets exported to China, at least most important if we are purely judging on the monetary amount or the value that is actually traded. Then, having said that, I think I already come to the conclusion and give maybe a brief outlook. Being aware that this presentation was very descriptive, in general, we are able to identify not only the goods that are traded, but can come to a distinction what is actually traded by whom, who are the main exporters and importers at the world stage. As I said, handily we can refer to existing definitions to do that. However, there are some issues that have to be stressed. One is, of course, this multiple use problem I already mentioned. But there are other challenges that I think could be discussed at length. For example, we are faced with just the observation that it's very hard to account for the change in technology costs or the price associated with the good. So, for example, I think the most prominent case is, of course, PV cells or the technology as a whole, where in recent years we saw a steep decline in costs. And this, of course, translates to lower trade volumes as well. So just because we are seeing declining numbers on aggregate, that doesn't really mean a country has gained a significantly less strong position or something like that. Here it would, of course, be interesting to have some physical measurement, depending on the good that might be in fact possible. But we found that data coverage is getting really sparse there, and it is really difficult to make some consistent observations, so to speak. And speaking of data coverage, that is in fact also the case for the last point I want to make, and maybe that's some sort of an outlook what would be really interesting. During this project, we also tried to have a look on services and how those are traded across borders, or trade is maybe trade in services, so to speak. And while there is a statistic, we can use the balance of payments, for example. We found that the aggregation level is far too high to make an really informed statement about trade specific to energy technology goods. So the multiple use problem is just far too high there. And we also found that the data sets are sometimes inconsistent, and there's really the need for some consistent database, where I think Comtrade is really the state of the art right now, where you could easily turn to. All right, I conclude with that. Thank you very much for your attention, and I'm happy to take any questions that might occur.
Okay, thank you, Maximilian. So we have time for questions. Are there any questions from? Yes, Karen.
Well, thanks very much for that. I guess I'm not saying that you should have been able to do this, but from all these data, can you get any sense, or is there a basis for analysis if there's a source of comparative advantage for Germany? Because I guess that would be able to think going forward what so far has caused the market share of, I would imagine, a growing market to sustain, and how might it evolve in the future? I think with so many products and things like that, is there any basis to study the comparative advantage here, whether or not there is one?
Yeah, thank you very much for that question. Yeah, I was only briefly able to touch on that now. We looked at some indicators that give us a broad sense. So the typical ones like RCR and RXR, where we can actually see that, yes, Germany has an advantage that you can also derive from the data. Of course, here it again depends on where you shine the light, so to speak. So if you're focusing on individual groups or go down to the more detailed level. What is then, of course, interesting is what we were mentioning, that the projection into the future. During this project, and this is where mainly our colleagues were involved, we try to make some broad analysis and modeling the trade flows in the future. However, that already faced the problem that this was before COVID, where in fact right now we are looking at a carry-on project, so to speak, where we are once again facing that exact question. And we are, in fact, right now in the process of another project where we are looking at actually simulation runs and try to somehow identify what are the drivers that are responsible for competitive advantage of Germany, or for that matter other countries. And yeah, I think it's a really interesting topic, but very hard to derive from existing statistics or data.
Okay, Gregor, I think you have a question.
Yeah, thank you very much for a super fascinating work on the Comtrade data for this topic. I'm afraid it's going to be more of a comment than a question. I hope you don't mind. And that is mainly that there's this whole literature around economic complexity in the product space. And there's actually a recent paper by Mealy and Teitelboim that tries to look at what you're doing. And, you know, they're forward-looking in the sense that they attempt to say which products are close, which green products are close to countries' current exports. And surprisingly, to me, Germany came out top in their analysis. So I don't know if this is at all, you probably looked into this already, but maybe that's something you could kind of compare your results with and use as a more forward-looking measure. And just a very small comment, your chord diagrams are amazing, but since it's a bipartite network, couldn't you just show a Sankey diagram and thereby, you know, make it clear what goes from where to where? Just stylistic. Thanks.
No, thank you very much for both comments, especially the first one. I'm familiar with this work. We are definitely checking this out again. Yeah, sure. Complexity is one thing that I think is very often discussed, especially with Germany, with competitive advantage of Germany. So yeah, thanks for that remark. And with regard to the chord diagrams, yeah, we tested some visualization. We found in this regard it makes sense to combine both dimensions. Which seemed easier with chord diagrams than with Sankey, but yeah, I think it's a matter of taste.
Okay, Emre.
Thank you very much. It was a great presentation. So I have a question. So I think one of the main issues with green products is how you decide it is green, and so how do you do it in your research? And so I was part of a discussion in CERA Week, and I think this is quite challenging. And so do you anticipate there will be certificates, how these will be applied globally? So who will have this power to claim anything is really green?
Yeah, that's a very good question or remark. Thank you for that. I mean, with regard to our project, I think we can say we took the easy way out, so to speak. So on the first hand, building on existing work where somebody else thought about it, and then our colleagues from the IAEE really had a large impact there, deciding on which are then, or which goods are then in fact relevant to us. So we basically just filtered the existing lists. And I think, yeah, there has to be some consensus. I mean, OECD is probably a good, yeah, first institution to agree on something like that. I mean, if it gets more and more political and there would be some consensus there, that of course would be great, but I'm not sure if you can expect that. I mean, just picking one example that I think is always discussed is nuclear, where I think the opinions already are quite differentiated, so to speak, if it is in case green or not, and every country has a different opinion on that. So yeah, I agree that it is an issue that has to be discussed, but I'm not sure on the process that can actually lead to a clear-cut definition.
Okay, I have a question which is linked to that of Emre. I'd like to know, is there some connection between this taxonomy of goods, of unlawful goods, traded goods, and the European taxonomy of green activities in the context of the European Green Deal?
Yeah, that's a good question, and I'm afraid I cannot answer it definitively. So I know that we looked into the European definition now for another project, and I think there are some overlaps between the list we used and those definitions, but I cannot say right now how large those overlaps are. I mean, I think the European terms might actually refer now to a newer classification. I mean, this is one problem I think I should point out again. Doing all our data work and with Contrade, we were interested in, yeah, as I showed the year starting in 2000. So what we did is starting with HS 2007 and then somehow adjusting the classification before that, so that we get, in fact, time series. And starting in 2007 even, we see that many goods we would be interested in are in fact not seen in those lists either. So I hope the European list now is a little bit further in time. I'm not sure about that.
Okay, so I think it's time to listen now to Gregor Semieniuk, who is the third presenter. Thank you, Maximilian.
Thank you.
All right. Yeah, thank you. I hope I can share my full screen PowerPoint. How does this look? Do you see something?
Yes.
Great. Okay, well, thank you very much for attending. And this is about the financial geography of stranded oil and gas assets. Research has evolved a little bit since I handed in that abstract, including the title. And this is research together with my many wonderful co-authors, who are not all at the University of Massachusetts Amherst. In fact, I'm the only one. And with that, let me jump in, just talk to you briefly about just why we're asking this question, telling you the model that we're using to answer it, and then some results. So to start with the research question, you know, by way of background, logistically, these colleagues are mostly in the UK, actually, and this is research funded by the UK's Natural Environment Research Council in the Frantic grant. We have a companion paper that's currently under review, and actually it's maybe interesting for Felix, because it's all about how trade flows shift with a low carbon transition, and also a review paper more on the financial aspects of a low carbon transition. So the idea is that, you know, you get very diverging narratives currently about how the future evolves in the energy sector. The International Energy Agency just published its net zero by 2050 report and sort of came around to embracing renewable energy, some people said. At the same time, you know, the oil sector revival is being talked about in the Financial Times. So, you know, what should you believe? How will the future evolve? Will oil demand go up or down? Gas demand up or down? Is gas a bridge, or will it, you know, uncertainty? And so the problem is that when expectations are frustrated and assets strand, that is, you know, your expectation adjusts and you realize that what you invested in doesn't really generate profits anymore. When you invested, you thought they would. Is that, you know, somebody owns these assets, and while there are now pretty good empirical studies on early retirement and stranded assets in the fossil fuel sector and beyond, you know, in fact, there are more than 100 studies of early retirement. The location of stranding is just the country of production where this asset, physical plant and equipment stands, and who actually owns that is not traced. Emre just showed us all of these gas plants, right? That these turbines that are sitting somewhere and that are sitting in the US. But what if they were all owned by, you know, who owns them? Is basically the question. So who's going to lose from this? So this is where we're going with this. And so our research question is, how are stranded assets at the oil and gas field distributed across the global pool of wealth? Okay. Of course, under various scenarios and expectations realignments. And we capture all 4 types of asset stranding identified in a recent review by Van der Ploeg and Rezai. But we only look at upstream oil and gas assets, and we also do not check out the supply chain. So it's a window into the potential stranding. And we're looking at stranded carbon, so reserves that unexpectedly remain underground. Stranded physical capital, so the oil rigs and pipelines and so on that have been built to make use of these. The initial revaluation, that is, you have different prices that you get for every barrel that you can still sell. But we don't have any delayed revaluation, so we're looking at some sort of an inevitable policy response, as the PRI calls it, and you know that expectations change in 2022 from one scenario to another. So the 4th type of stranded asset is wrapped into the 3rd one. Our strategy is to generate baseline and policy trajectories of oil and gas, quantity and prices at the global level using the integrated assessment model E3ME, FTT, Gini. And then we assume that expectations about future revenue realign from the baseline to the policy scenario. You know, to give you a very brief glance, if you want to look at this in detail, this is published in this working paper currently that I referenced earlier. We sort of have 2 baseline and 2 policy scenarios. The baseline scenario is, we call it investor expectations scenario. Yes, we were also a bit hamstrung by COVID, but the idea is basically that COVID is returning, you know, the demand returns back, and investor expectations are basically pretty conservative. IEA 2019 current policy scenario, their baseline scenario pre-COVID. TDT is an in-house technological diffusion trajectory that takes current diffusion rates seriously, and you know, is a much more optimistic scenario about renewables diffusion. And I just want to point your attention to the top row here. This is fossil fuel demand, and in that TDT scenario, total fossil fuel demand, primary energies, basically flatlined, okay, starting now. So this is a much more optimistic baseline scenario, meaning your expectations can't really be that much frustrated if it becomes even more, if there's even more climate mitigation. And then we have our 2 policy scenarios. This is kind of a realistic policy scenario where the EU and East Asia follow up on their, or investors expect that they will follow up on their net zero pledges in 2050, and in the case of China, 2060. And then we have the Paris aligned net zero scenario. But in this presentation, I will really, let's see, I will really focus on the switch from this scenario to this scenario. So pretty conservative baseline, but also not too ambitious policy scenario. Okay, how does this look as a preview? We have revenue trajectories under the baseline that goes up here, and under the policy scenario, and obviously the wedge here is the net loss revenue. But what we are really interested in is the net loss profits, which are a lot less, right? Because the revenue also has to cover wages and supply chain costs. And so these are the upstream oil and gas profits that are lost. Look pretty small. They get even smaller because then these profits are discounted. We use a 6% per year discount rate. And we look ahead 15 years only. So this is a lot less than the McLeod and Eakins kind of all the reserves that could possibly be ground up, extracted. We have to take those into account. Not only that producers reasonably expect to produce in the next 15 years, which is sort of like a planning horizon for an oil company. So having done that, we allocate these global future lost revenue to 3,000 company headquarters based on the Rystad oil and gas field, break-even price and revenue sharing data for 120,000 participations in oil fields. The oil fields themselves is about 77,000, which Rystad covers, claims is the global pool of these. And then we trace profit losses through the ownership network using the Orbis database, where we have about 1.8 million companies and about 7 million ownership links. This is a lot. Actually, not all nodes are shocked in this particular scenario. It's more around 100,000, but one can certainly use other shocks on this population, other sectors, for instance. So the results are basically that we get $1.4 trillion in stranded assets to be distinguished from $6 trillion in unrealized revenue, okay, discounted to the net present loss. And what's really at the heart of our analysis is that OECD countries only lose 36% at their domestic oil and gas wells. Think North Sea oil or US shale oil. But they actually own more than half of the ultimate wealth loss. So there's a large international transfer. We also see at least $400 billion channeled via financial market equity, meaning financial market actors invest in oil companies, and at least an additional $300 billion channeled via asset managers that do not own these equity, but they manage them for pension funds and so on. So we see a large potential for amplification of this initial loss. Finally, what was kind of surprising is that OPEC behavior, they could either sell out and try to capture the market, or they could abide by some quotas like they do today, sort of makes relatively little difference for advanced economy losses in the aggregate, because some countries lose and others gain. You know, US shale producers will gain from an OPEC quota, but investors in Exxon that operates in the Middle East actually lose. So it's actually, there's no sort of united front of rich countries trying to pressurize OPEC into lower production levels if people expect a transition. So what I show you is a scenario where low-cost producers try to capture the markets, what we call sell-off, SO. So the model, I probably have to rush, that's okay. The model is can be depicted like this. Conceptually, this is where the integrated assessment model operates, and I'm not going to speak about this, but this is published in several papers and is currently this working paper that I referenced. What I want to spend a little bit of time on is the network model that partitions the global loss in revenue and profits and partitions them over these headquarters. I mean, first of all, over actual oil fields, and then oil company headquarters, the network of ownership, and ultimately the ultimate owners. Ultimate owners are either individuals or governments. A company cannot be an ultimate owner because somebody owns the company. Sometimes called beneficial owners because they get the profits or the dividends. These are 4 stages, and at stage 1, what's to be kept in mind, forget about the formulas, but just take a look at those diagrams on the right-hand side. The reserves of oil in Saudi Arabia are just a lot cheaper to extract than those in the US. So when we have a decline in the oil price, we use these break-even cost profiles along with asset reserve ratios to calculate which assets will actually stop producing. And as you can see, the US is much more vulnerable to such curtailment of production than Saudi Arabia. Now, we then distribute these losses from these oil fields, they're called rig here, safe space, to their headquarters, HQ. And how much every headquarter gets depends on just their discounted stream of lost future revenue from stranded rig to the headquarter, scaled by their ownership share. So often there are revenue sharing agreements, notably between oil majors and national oil companies in various, or directly governments in various countries around the world. And so we partition these losses across around 3,000 headquarters, which we then link with this Orbis company database. We lose a few companies here, but we carry about 95% of the loss that we estimate from Rystad. How do we deal with operating cost? Well, we do not look at the supply chain. So the loss is 100% in revenue. However, X% actually are operating costs. And Y% are just lost wages, right? So this is what's part of this dark green wedge between revenues and scenarios. But the lost profit that owners are worried about and financial markets are worried about, remember, this is about financial markets ultimately, and transition risks. These yellow boxes are very, very important and interesting. And there's a whole just transition literature about that. But so this is how we get our quantity of interest. Okay, and that's different from some estimates of what are called, I think, erroneously stranded assets sometimes. It's more like lost revenues, really, in some papers. Not erroneously, but it's just a different definition. So then we propagate the loss through the network without any amplification. We just pass on the losses. And some nodes, don't have owners, so the loss remains in them, and then we assume that it's an unknown beneficial owner in the same country as the headquarter or the corporation. So we underestimate international redistribution, but often we can actually trace the losses. Moving on, the results then are as follows. So, at stage 1, just as a broad headline, OPEC gets around 36% of the losses, but the increase in loss is already significant. The loss is always the same, about 1.4 trillion, but at headquarters stage, almost half of all losses accrue to OECD country-based oil companies and gas companies. Once you push the losses through the corporate financial networks, the loss goes all the way up to 55% and is then decreased a little bit because all these US fund managers like BlackRock and Vanguard and State Street Capital and so on actually manage the wealth of these global clients, including notably in China, but also other countries that are not in the OECD. So part of that loss is redistributed across the world to end at 53% losses in this particular realignment. Now, if we break this down by country and stage again, we get a lot of detail, which I don't really have time to go into, but I want to note a couple of things. At stage 1, you see a very kind of ragged surface here of those bar plots because they are ordered according to the losses, to the absolute losses at stage 4, losses to ultimate owners, which you see is a nice, smooth, monotone descent, except for rest of the world, which is not a lot. So the top 30 countries, some of them actually don't have any production losses, such as, of course, the British Virgin Islands, but also basically Japan, France, and look at Great Britain, hardly any losses in the North Sea. But you go to stage 2 and Great Britain really increases its losses a lot. And I see that, well, anyway, so, you see this tracing through the network in 4 stages here. And another thing I just want to point to is that we have this green bar here at stage 3. Those are the US fund managers that are basically managing most of private pension funds at some stage. And that is then transferred into fund owners' losses that are often pension funds, on which more in this graph. To unpack this, so as the loss propagates through the stages, it hits a bunch of companies, some of which may be listed companies, and some of which may be financial companies. Both of these matter because listed companies are very visible, right? You have a stock market index. And the top bar here shows that, you know, more than $1 trillion are actually lost through listed oil companies. And the amplification is fairly small. So there's a bunch of fund managers here, this red strip, that do not, however, own the losses, but the losses will show up in their indices. So that is a bad sign for financial markets that look for signs from these indices. Whereas equity listed financial companies own only a small slice of these losses and other companies. So the amplification in equity loss, and their equity is contingent on earning a profit on the companies they invest in. So that's not very large, but of course the initial shock is very large. But then the financial sector actually owns quite a bit of, or at least manages quite a bit of these losses. And there is about 400 billion in losses. So almost 40% of the loss is owned at some stage in this chain by the financial sector, which again leads to amplification because these companies justify their existence by earning a profit from other companies. And then we have another 300 billion being managed by, that's this same bar here, by fund managers. Okay, again, the losses are unequally distributed geographically, and the US and Great Britain are by far the largest financial centers that are involved. But you also see the British Virgin Islands, Hong Kong, and then Canada, Australia, Russia, because of their home domestic industries. Again, Cyprus, more of a tax haven, Belgium, Netherlands, Luxembourg, all familiar names if you follow tax, offshoring of wealth and so on. I'm coming to my last graph. So what if we actually think about different realignments? So here are three alternatives that look at headquarter shocks, because presumably it's ultimately going to be headquarters that, you know, that where people look at, you know, what would it mean if we aligned our policies with a different scenario? What would that mean for those oil companies? And maybe these companies would lobby against that, or countries if they're state-owned companies. So there are three alternatives. One is a TDT baseline. That's the much more, you know, aligned baseline with climate targets. And what you see is that all the big producing countries, basically, these are a selection of 20 important countries. Every country cuts their losses because everybody knows that there's less oil to go around. But what's interesting is that OPEC producers actually make a profit because they're still operating at the sell-off policy. And so they are actually capturing more additional market than they lose by moving from an investor expectation to a TDT scenario, a baseline, which cuts their own losses because they have aligned their expectations, which I'm not sure they actually have, but you know, they cut all their losses essentially. The interesting scenario that I want to draw your attention to is the quota scenario, which is when OPEC producers stick, in the extreme case, to their current quotes in global output. And for some reason, they stay there in the foreseeable future, next 15 years. So the market shrinks, but every country keeps their production share. And because of the ownership structure of oil fields, it's actually not clear that this is good for rich countries, for non-OPEC countries. So for instance, the US slightly cuts its losses because all the shale producers at home are of course happy, but oil majors are not. Russia cuts its losses quite a bit. Canada does because of all the expensive tar sands and so on. But Great Britain actually increases its losses because BP and Shell are mostly operating in low-cost oil fields. Same for China. Norway again gains, not surprising, but then you see Japan, Italy, Netherlands having big losses from this policy. Okay. And of course, all the OPEC countries are also dramatically increasing their losses from this. So it's not clear that since they can decide to do this ultimately, that they would do so. Okay, I have to stop. I'm just saying that, you know, there are a bunch of caveats and assumptions about this, notably, which I find important, there is no financial upside risk from low carbon investments, which could partially hedge these losses. But also we exclude a bunch of follow-on shocks and supply chain shocks. So but there's a lot of space for policy, but also a conservative lower bound on the assets that are at risks, because we're not looking at all of them. So the main takeaway is that there's a wealth loss that shifts from oil-producing countries that also lose wage income to the global north in the form of lost profits that are transferred internationally. The majority is lost by private shareholders, which I haven't shown you, but that is so. And the amplification due to listed company and financial sector involvement is quantitatively important, as is the institutional investor involvement. So there's a question about transition risks that could arise from this, which requires follow-up research. And I'll stop here. Thank you very much.
Okay, thank you, Gregor. Some of you may have questions. Yes, Karen.
I don't know if I'm just jumping in or if I'm getting a ladies first, but thanks for that, Gregor. I mean, I think one thing that jumps out to me, you know, I mean, I'm just going to be talking about, you know, what we've been looking at with carbon capture and storage. Mm-hmm. A lot of discourse around repurposing assets and things like that to stop, you know, to avoid getting stranded. But, you know, one obvious thing is that, you know, the value of the output, if you were selling carbon sequestration services, is nothing like the value of output that you have with selling oil. You know, I think it's probably already in your analysis partly, but I guess I'm just asking you to put your neck out there in terms of when people talk about repurposing of assets for low carbon solutions as being the answer, how much of an answer do you think it is?
Yeah, thanks. That's a great point. And I think Emre is probably more qualified to answer. So we basically, there's fairly limited potential for repurposing assets in the E3ME modeling environment, which I am not part of the core modeling team. So I feel a bit uncomfortable making a strong stand on this. But as for the purpose of this presentation, this is actually ignored because we're just calculating sort of the gross loss from oil and gas revenues, which might partly be offset by what you just said, that there's a repurposing. But I also wouldn't underestimate the cost of this repurposing, right? As you said already. But I'm afraid, yeah, this is, as so many other assumptions that we make, you know, it's a very specific scenario, and this little sensitivity that we did, there could be many other dimensions in which sensitivity would be adequate to do. Thank you.
Emre?
Yeah, very interesting talk, Gregor. Thank you. So I have one quick question about, like, how do you interpret these results from a company's perspective? What is the action item that they need to take to make sure that they are not hurt or potentially fix the problem?
Yeah, yeah, we're actually getting quite a bit of interest from financial sector types in this model because they would like to know their own exposure, right? It sort of kind of discloses a little bit one potential exposure. So what can you do? Well, as an oil firm, you can diversify away. So if you're in that sector, which is of course pretty hard, and somebody still needs to produce all this oil and gas, it's not like it's not there anymore. But you can follow that in the news, how this is currently going. for these majors. But as an investor, I think the issue is that you basically want to diversify away from these assets, but you also want to keep the dividends, which are also still coming. So I think the key here is then expectations management, and if there is a good understanding of, or good consensus about what these companies will do in the future, there's no surprising loss, right? Stranded assets is only when you didn't realize it and you totally overvalued the company and put in all this money and you're not getting a return. And the worry is that this kind of thing could happen. And I've only shown you really the tip of the iceberg, because we also trace creditor loss, but unfortunately getting data on who owns whose debt is a lot harder even than equity, which is super expensive, but you can at least buy it if you have the resources under a grant. But there's no publicly available data on debt holdings. So the worry is that, one, you don't want to be exposed, but you also don't want the entire financial system to be exposed, because then you could just, if there's a financial instability building up, and then everybody could lose. So really what you want as a company is that regulators and companies all talk to each other, and policymakers set out these clear expectations and so on and so forth, so that you make your profits, which maybe most of us don't really care about if a few rich investors lose their money, but maybe we do care if it's pension funds that our employers invested our incomes in, or if there's financial stability with repercussions in the wider economy.
Okay, we shortly have two questions, one by Maximilian and another one by Carrie. Maximilian first.
Thank you very much for this interesting presentation on the topic. I've got one question regarding the OPEC. I mean, I get the impression now, but that may be too far-fetched, that the need for coordination might be actually gone in the future. So if not even the OPEC as a whole profits from the quotas, would you support the thesis, or what's your assessment of that?
Thanks. Shall I take the other question too and answer?
Or
is no time? Sorry.
First
okay.
reply and then.
Thank you. Yeah. No. Okay. So briefly, and you can read that in this paper that's already out. For OPEC and other low-cost producers, it's the rational choice to actually flood the market, if you believe that markets are going to disappear. Okay. So that's pretty unambiguous. The question is, what do other countries think about that? Notably, high-cost producers such as U.S. shale and Canadian tar sands. So OPEC is a clear rationale. If there's a scenario. Sorry. Okay,
Carrie, for the last question.
You bet. Thanks, Gregor. It was a great presentation. A lot of work there on tracking those the companies. So I have a kind of short question. I was just thinking about one of your big takeaways charts was the percentage of the losses in OECD versus non-OECD, and it was about 50%. And I was just thinking, looking it up here and thinking OECD GDP is about 50% of the world. So how much, or do you have anything to say about whether this is just based upon who has the wealth and who's doing the investing?
Yes.
And it impacts them.
Yeah, that's essentially what this reflects. I mean, the global wealth is kind of distributed like that. So you would expect that it's also distributed like that in the oil and gas sector, except that I haven't quoted these authors, but there's quite a few people going around saying sort of like, it's really an oil producing country problem, which it is, because the revenue and the jobs are in those countries. But in my naive moments, I'm thinking, well, maybe this, if more people stand something to lose, more people could care about with a coordinated transition away from these fossil fuels. But yeah, it's really just showing that. And then the follow-up question is, does it matter for financial stability?
Okay, thanks to all of you. We are just on time to listen to the last presentation by Karen Turner. Karen, can you share your slides? Okay, that's fine. Thank you. Up to you now. Karen, we do not hear you. I think that you mute your microphone.
Yes, sorry, I did that accidentally. It's the troubles of doing a conference virtually for the first time. So, well, hello, I'm Karen Turner, and can I note that despite what it says in the programme, there are multiple co-authors in this work, and you can see their names. So the low carbon innovation that we've been focusing on in our project, which is in partnership with the Bologna Foundation with funding from the Children's Investment Fund Foundation, is around carbon capture and storage, CCS, with particular focus on wider economy impact. So you can, you can see our question here, is there a need for policy intervention to offset costly capital requirements in supporting industrial decarbonisation? And here we're focusing in particular on carbon capture. And basically all of our work, we're general equilibrium modelers, CGE modelers. We're looking at how the impacts of innovating and bringing in solutions, be the energy efficiency or carbon capture, different things like that. Do they bring additional costs to the economy, or might they generate benefits that could offset the initial costs? So when we're considering carbon capture and storage, we're very much considering an economy. Our title's fundamental research question. So how do we address it here? So what we're asking is, what are the implications? Our project is asking, what are the implications of introducing carbon capture and storage? And we've separated into the distinct elements of the capture side, particularly in industry, and then the transport and storage, which relating to the question I just asked Gregor. In the UK, that's envisaged that the oil and gas sector would play a key role because of the assets and capacity that they've already built up, although that repurposing would be required. And I think a key thing in our work talking to industry players, it's important not just to limit consideration to upfront capital requirements. It's crucial to set this in the context of operational challenges and implications. And in the project, we've introduced a two-step process. We call our model UKN because it's a UKCG model.
Sorry, Karen, I think that we have some troubles with the sound. I don't know if it's just on my computer.
I have the same trouble.
Same problem.
Karen, we lost you.
Yeah, but we lost our video too, so I guess we're not the only one.
No, you're not the only one.
We lost our video too, so I guess the problem is from her connection.
We have to wait until she connects again.
Yes, we can wait a couple of minutes.
Okay, Karen, you're back. Please.
Internet connection remained, but my Zoom connection went. So
yeah, we lost you during your presentation. I
think
you were speaking about your second slide.
Right. Thank you for that. So I'll put it back on the slide view. Okay, so carbon capture and storage and economy. So we're looking at the implications of introducing carbon capture and storage, and we're looking separately at
Can you just share the slides? Or?
Oh, sorry, is it working again? Sorry. It must have all dropped out and I lost the Zoom connection, sorry. I need to get it back up, share screen. Okay, so here we are now. I don't know what happened to the Zoom connection.
Okay. This is the slides.
Yeah. Typical, isn't it? Your connection works all day. So we're looking at the implications of introducing carbon capture and storage, and we're looking at it through the distinct elements of capture, particularly in industry, although obviously capture can happen in power and other sectors as well. And we're separating from transport and storage, where linking to what I just asked Gregor, it's envisaged in the UK that the oil and gas industry could play a key role in delivering transport and storage or sequestration services. And we're not limiting consideration to upfront capital requirements, because talking to industry players, it's crucial to set this in the context of operational challenges and implications. In our economy-wide model, we're, as I said, we're separating out industrial capture and a new sector that would deliver transport and storage. We're working on both, but I'm only going to talk about the first one today. And we're doing scenario simulations. We do it year by year, but I'm going to focus more on long-run adjustment here with the kind of interim 2030, which is important in terms of UK's industrial cluster emission and when some of this capacity would be expected to roll out. I should say that the abstract I initially submitted back in 2019 when the conference was off last year, it was on some Scottish work that we'd done for the chemical industry. That's now been published. So I'm presenting today on work that we're doing for the UK, where we're expanding our consideration of different issues. So we're taking the UK as our case study, where capture and transport and storage are subject to distinct policy considerations and actions. And in the context of capture, they're looking at an industrial capture contract as a subsidy mechanism that's designed to address a kind of the driver of competitiveness loss if firms have to bear additional costs in doing carbon capture, which relates to capital efficiency, because basically this is an end of pipe treatment. It will have ongoing operational capital cost implications. So for example, if carbon capture doubled the equipment requirement to produce 1 unit of output, basically your capital efficiency has halved. And this will impact both the price of output with competitiveness implications through relative price changes, coming through the impacts both on exports and downstream demand. And especially we're focusing again in the chemical industry, where there's very complex supply chains, with the UK chemical industry servicing itself hugely within the UK, but also, you know, a major exporter. And where this results in import substitution, the policy concern is that there will be investment and jobs leakage. And the results I'm going to present to you today is, talking to industry, we're looking at an average 30% capital efficiency contraction in UK chemicals if they were to do capture. We've had to work with an aggregate chemicals group just because that's how the input-output data that informs our model is configured. And we've done different sensitivity analysis, I'm not going to report it all, for different current or potential future trade responses, particularly as international competitors in the chemicals market either bear similar costs or green markets start to emerge, you know, and the end consumer will be happier to pay a higher price. But that's very complex for process industries that are operating in complex international supply chains. I'm not going to go through all of the CG. The main thing is to focus, we're looking at carbon capture only in the UK chemical industry. As I said, the suggestion is an average of 30% capital efficiency loss, and we build that up over 10 years, really to try and represent a gradual adoption of carbon capture, but that's a time frame that's given by the UK's industrial clusters emission for decarbonising regional clusters in the UK. If we don't have any policy intervention, we've basically got a broad polluter pays outcome. The capital efficiency loss forces an increase in the price of output, with economy-wide impacts then being triggered by the consequent demand contractions. And we've got the assumption here that the UK chemicals industry is either an early adopter or the competitors' prices are somehow being cushioned in other nations. And then we consider, what if there is a policy intervention in the form of a subsidy just sufficient to offset the need for an increase in the chemicals industry's output price in response to their losing capital efficiency, because that kind of aligns with what the industrial capture contract is trying to do. And for simplicity, we've taken that here. We've done other things elsewhere. We just do this through a lump sum tax that's paid by households, and that's basically a non-distortive tax, so you don't have any kind of supply chain impact, but you are getting effects on real take-home incomes, which funds household spending, which that means that when you're redistributing the cost here, you're not only hitting households, you're hitting the sectors that they spend their money on. And just our CG model is well documented, but I guess a key thing here is that we've got a constrained national labour supply, which I guess is more relevant with Brexit and cutting off a free movement of labour. Investment's endogenous, so as demand for industries grow, they will invest more. But in the case of adopting capture, that's an automatic investment need that isn't necessarily going to increase. Well, it's not, adopting capture is not going to increase the output that's produced. So these are the first sets of results, and we've broken them into, in the first column in each block, that's where households are paying through a subsidy, and the second column in each case is when polluters are paying for this directly themselves. And we don't have any changes in import or export prices here. It's just a pure polluter pays. And basically, if we look at 2030 on the left, this is where you've got both scenarios, and so it's the data columns 2 and 3 from the left. The first one's the base year data. But basically, the argument is that the UK government is committed to some kind of early subsidy to cushion any negative competitiveness effects. So I guess the 2030 results are more relevant when you're looking at the subsidy case. They're unlikely to carry a subsidy through to 2050. And we're doing these simulations on the basis there's no change in the price of foreign chemicals, so that the UK really is an early adopter, certainly in terms of paying for this. And I guess the results are that if you fund this through tax, which seems a likely choice given the government's present position, although the impact in the chemical sector becomes relatively small because it's been cushioned, the overall impact in employment and real household spending could end up being worse for the economy. And I guess so basically you're redistributing the cost. It becomes good for the chemicals industry, but has a relatively large effect on UK households and where they spend their money. And then if we go forward, we run the model forward to 2050, they're broadly similar results. So while this is a shock to the economy, it's not that big, so the economy adjusts quite quickly. But there's still some adjustment taking place. And in particular, if you continue to subsidise this, it takes a lot longer for the economy to adjust. But basically, if we had the standard polluter pays with non-adoption in other countries or continued cushion prices, the last column there would give you the final outcome for doing carbon capture and having polluters pay for it. And it's basically, it's negative for chemicals and it's negative for the wider industry. So you're adding to the cost of actually doing capture for industry to the wider economy being a cost due to the knock-on effects. I guess the key question is, what if the international situation were to change? What we have here, and if we focus on the case to 2030, we're assuming that competitors in other countries either do not impose carbon capture or they act to cushion the price impacts. So I guess our first question is, what if the UK continued to go it alone? It might seem quite unlikely, but if they would continue to be the adopters of carbon capture, but they acted to address price differentials via an import tariff. And I guess this is kind of important because it's, while we're only working in a single nation model, so we're not doing it fully, this is what you're starting to ask what industry's pushing for, things like border tax adjustments. And so we look at that here, the import tariff has to be greater than the direct price implications of capture, really due to kind of a world price multiplier, because UK chemicals is both directly and indirectly import intensive. The second question we ask is maybe the more obvious one: what if other nations followed in adopting carbon capture? And the third one is, if the UK, I guess one of the arguments, if the UK went early in adopting industrial carbon capture, that it could somehow gain a comparative advantage in operating it, thereby reducing that capital efficiency losses that's the driver of the losses. So these are the results we've got when we look at these three questions. And if we take the first one first, you know, what if the UK continues to go it alone but acts to address price differentials through an import tariff? And this is the middle column here, the third column from the left, where we've got the import price plus 6.9%. So this is simulating an import tariff that corrects for countries not adopting or subsidising. And as I said, it's a first, albeit limited, kind of crack at looking at what if there was a border tax adjustment. But the key point here is, contrary to what a lot of people will argue with border tax adjustment, is that on many variables, this is actually the worst outcome for UK chemicals and for the UK economy. And this is all about the import intensity of chemicals. So I guess you would maybe get more granularity if you broke down to different types of chemicals, but you basically add additional pressure to the price of chemicals output. So this kind of very, very simple border tax adjustment, it suggests that it's not as straightforward as just taxing what competitors do. If we move to the second question, what if other nations follow in adopting carbon capture? Here, then we're assuming that all the countries that the competitors in also adopt carbon capture and storage, and they face the same cost increase in chemical and they have polluter pays, so that 6.9% is matched by that in all of the other countries, both export and import markets. And this is the outcome that's in the fourth column here, or the fourth column from the left, or the second from the right, the second last one. And I guess compared to the unadjusted polluter pays that we've got in the second column here, the impact on the reduction in chemical outputs is much, much less. It's still over 2%, but it's much less than it was before. But overall, the impacts are still negative. It's not pulling the economy out of this negative situation of adopting carbon capture. So you've basically got something that, if the costs remain the same, the implications for capital efficiency remain the same, you're going to keep on with a negative outcome with carbon capture, so that the costs are greater than what's directly been phased. But if we move to the third question, what if the UK could gain some kind of comparative advantage as a first mover in carbon capture, thereby being able to reduce this overall capital efficiency loss? This is what we've got in the last column here. And this is the result of assuming that all countries have imposed polluter pays and carbon capture, but the UK, because of moving earlier and learning by doing, has now managed to reduce the cost to half of what it was initially. And that's quite broad brush. We would need to get some data to see how much they actually could reduce it from. But I think the key point that we wanted to do was to see, could we move the economy into a more positive position if somehow kind of learning by doing gave a comparative advantage here. And I think what we find here is that you still are getting, kind of a negative overall impact in GDP, but it's getting much, much smaller than it was before. And you actually get to a situation that the chemical industry moves into a net positive outcome, in that they're increasing their exports by about 5% here, and they're increasing the output of the sector. So basically, the sector really has gained a comparative advantage here. You do still have some wider economy-wide kind of negative effects, but they're much less than they were before. So it would seem the positive direction of where you would want to go. So in conclusion then, what are the lessons emerging from this UK policy and research context? I think the thing that we can't get away from is that because you're asking firms to use additional capital to produce the same output, you're going to have negative industry and wider economy impacts. And you're trading off against, there is discussion about what about capture supply chain gains, kind of, I think, aligning to the oil and gas industry, perhaps playing a role in delivering transport and storage. But from what I've heard, they could be quite limited. And I think it would be a challenge for that type of thing to offset some of the losses that we've seen here. We find that the negative impacts that we found this in our Scottish work in particular, we haven't done a lot of export demand sensitivity here, but generally negative impacts are greater the more responsive export and domestic demands are to these relative price changes. But as we saw in that final result, if we reduce these negative impacts, if there is some kind of gain in comparative advantage through improving technology to limit these capital efficiency losses. The challenge for the UK industrial capture contract is there's no fixed time frame in this. Really, the need for subsidy is going to depend on the evolution of market conditions. So follow our capture uptake, the emergence of green markets, so that prices could actually bear these increased costs. And as I said earlier, this is much more challenging for process industries that are selling into complex global supply chains. And it would be likely then that in operating this type of policy, you need to frequently evaluate the market conditions to see whether or not the case for the subsidy was declining, particularly when we see that when you have the subsidy and you impact household spending, you get a much wider dispersal of negative impacts in the economy. So you want to make sure that it's worthwhile. And I guess what this then does is brings in a predictability versus investability challenge for policy versus industry. As I said, subsidies always have economy-wide implications, particularly if you're having to charge your taxpayers, who are the people who go out and spend money in the economy. So you end up with a trade-off in distribution. So the extent of GDP and total employment losses across different sectors versus the industry that's trying to decarbonise, but obviously government wants to try and keep located because these are higher value industries. The other thing that we need to do, obviously, in this research is, alongside this, we're looking at transport and storage, but we're looking at polluter pays there as well, and that will have implications for these capture industries if they're paying these additional things. So we're bringing all of this research together, and I guess I'll just close by saying, kind of who knows, perhaps one of my colleagues or I will actually get to present this in person next year without the glitches that we had at the start. And I'm sorry about my loss of connection. I'll end there.
Okay, thank you. So, are there some questions? Yes, Christian, you have a question? That's it?
No, I was clapping, sorry.
Ah, okay. So, nobody has questions? So I will try to ask a question. As far as I understand your model, what you call polluter pays scenario is a scenario where actually the polluter bears the cost of complying to the objective of adoption of carbon capture and storage. But did you compare this scenario with a scenario with a carbon tax and the recycling of the carbon tax in the form of a subsidy to investment in favor of CCS?
And I think, well, we haven't done that yet in these scenarios, but that is one of the things that we could look at here, because basically what we did do was have a subsidy and look at the pure socialization. But, you know, the other thing is at the moment, what we have in the model is that, you know, industries in our baseline are paying carbon taxes for various reasons. The problem is the UK doesn't earmark taxes at the moment. So they wouldn't do, at the moment, the UK policy environment, they wouldn't do that of earmarking carbon taxes to pay for this. But that is one possibility, and it is something that we could look at modelling going forward. It's just not clearly something that would happen in the policy context at the moment. At the moment, they would fund it out of general taxation.
Okay. Gregor?
Yeah, thanks. And maybe this question is not appropriate, but when I saw your name, I was first thinking about rebound effects, and so I'm just asking, you know, in some sense, this whole capital efficiency, isn't this also a little bit like an energy efficiency situation, except you're looking at capital instead of energy? And have you at all looked at the energy demand implications of such a shift? I would imagine it might also be more energy intensive complementarities.
Yeah, I think the interesting thing here is that the capital efficiency is that even in these energy intensive industries, capital is a much more important input. And of course, then it has investment implications and return to capital implications. So while there is a similarity to energy efficiency in terms of that it's resource productivity, the way that the implications carry through, that it's the return to capital is what is getting affected here, and that has investment implications, and it's more likely to be the type of thing that would trigger an offshoring decision, because certainly talking to people in the chemical industry in the UK, it returns to capital as the kind of bottom line with a lot of decision making. But I think you're right. I think, you know, one thing that at the moment we've just put carbon capture on is like an end of pipe treatment. It's just an additional cost. But if you started to look at what the input structure for this is, I think, you know, as I said, on the one hand, some people say, are there supply chain opportunities here to supply some of the chemicals and things like that that you use for capture? But if it increases the energy intensity as well, that can have direct and indirect implications, I guess, for energy use and for emissions. And I think, you know, linked to that, one of the big concerns about carbon capture is that if it is supported too much, it will incentivize continued staying with the same production methods and the same energy uses, rather than trying to switch to some other type of energy use and production where you wouldn't require the carbon capture because it would be less emitting in the first place.
Okay, thank you. No more questions?
I think it's the end of the day, isn't it?
Yes, everybody's tired maybe. We still have some minutes if you want to ask questions. No, it's okay. Yes, Christian, is it a question this time?
I can ask a question now, if I may. Apologies for my voice. I have a bad cold. Yeah, thank you, Karen, for the presentation. I think also staying here in the UK, the other big component of industrial decarbonization has been hydrogen, and the discussion has always been about hydrogen. So it's interesting to see or to hear your views on how will CCS work with hydrogen in decarbonization of industry.
Well, I mean, I think I mean, I'm not a technical expert, but certainly, you know, kind of from an economist point of view, you know, I think a lot of the discussion is that initially hydrogen production would involve working with natural gas. And what is it that you would then be moving the carbon capture to a more centralized upstream point, which would then, of course, impact on prices, you know, and what the price of hydrogen would be for firms and things like that. But that would be the major shift. You wouldn't be having the capture happening at the individual firm level. You would be having it happen in a centralized point where the fuel is being supplied, and it would then impact the price of the fuel, the hydrogen that they were using, rather than, so it wouldn't manifest in the same way at all. It wouldn't be additional capital equipment for capture, although it's switching to hydrogen, you know, whether or not that involves, you know, kind of upfront or ongoing different equipment. That's something that we would need to look into, but basically it would be different from the capture point of view, because the capture would be happening in a centralized point and producing the fuel type. And if you move to hydrogen, then you wouldn't, that would be a different picture altogether.
Okay, we still have time for last question if you want. No. Okay, oh, sorry, I have phone behind me. So I think it's time anyway to end the session. Thank you to the presenters, and thank you to all of you for your participation. And I hope it will be helpful for your respective work. Okay?
Thank you.
Thank you.
Thank you.
Thank you.
Bye-bye.
Thanks, everyone. Have a good time.
Bye.